Out. Okay, I'd like to call to order the meeting of the pension board for Wednesday, March 13th, 2024, and review of the minutes, and if there's any changes, and if not, is there a motion to accept the minutes as written?
I was able to accept myself.
I'll make the motion unless somebody has any comments. Motion to accept.
Can I second?
Sure. All in favor? Aye.
Aye.
Perfect. Public comment? Any public comment? There isn't, so we'll move on to the next pension application approval. There's one pension, and is there somebody here? There isn't actually. Nina, are you on?
Can you hear me?
Yep. Excellent.
Hi, everyone. So we have one pension application this evening. It's for Timothy Thorne from the Board of Education. He was with the Board of Ed for 19 years. The pension will commence on December 30th of 2023. It's an early pension, and he has selected option 3.
I looked it over. It seems fine. Anybody have any questions on it?
No.
No, is there a motion?
I move we approve it.
Second? All
Second.
in favor?
Aye.
Passes unanimous. Perfect. Thank you very much.
Thank you.
Okay, asset allocation review.
So since I do not see Rick on the Zoom yet, I know he's in an airport and trying to find a quiet place. Do you mind if we do the January performance review
That would be
first?
perfect.
So we have in the materials we sent, there's quite a bit of material. We have the quarterly reports for the pension and OPEB, the executive summary from the fourth quarter, and the January monthly report. So I will, since we reviewed December performance last month, I will focus on the January report. Assets, about 499 million at the end of January. Another reasonably strong month for investment returns, largely driven by the growth equity markets. You can see about 630,000 investment returns and about 3.5 million going out the door to pay benefits. In terms of overweights and underweights, pretty consistent with the past few months. Equities really at a whole in line with the target. The U.S. equity allocation is a little bit over target given the strong performance. International is right in line, and you can see the underweight to global equity long short given Blackstone's termination, and slight overweight to private equity. We did want to point out that UBS, who's done a nice job, is almost 2% over target. So when we talk about the asset allocation and, you know, in the future, if there is a desire to rebalance, that might be an area to submit a partial redemption to rebalance closer to target. It does take about 3 to 4 months for proceeds to be paid. So just something to keep in mind. In terms of performance on the next page, as I mentioned, U.S. equity markets have continued their strong returns in 2024. Fiscal year to date, specifically LSV has continued their great performance. You can see now over all periods, they've outperformed their value benchmark as their deeper value style has come back into favor a little bit. Principal, if you recall from last month, underperformed in the fourth quarter pretty significantly as we saw the Fed get more dovish on interest rates, and the markets reacted significantly towards December, and growth markets specifically went up significantly. Principal did do a better job in January and outperformed and closed the gap a little bit fiscal year to date, but you can see their underperformance going out to the 3-year period. But longer term, they've done a very nice job for the pension plan.
Should they be on the watch list after 3 years of underperformance and negative performance?
Yeah, I mean, so we've had them in every year, I think, for the past 2 or 3 years, given the organization changes and the PM changes. Certainly performance is a concern, and we would suggest having them in again this year. to get an update from them. You know, it's a small team that has had 2 years of mediocre performance, certainly versus the Russell 2500 growth. So yes, you know, they're a manager that we are watching very closely and have been with the board for a number of years.
Might help after the, we'll see in the the quarterly too, to get a better sense. I mean, I know we can look back at the fourth quarter report too, but just to see how they're standing in the last 3 years versus the peer group as well. And whether it's more just of an index issue. I mean, they did have a pretty notable bad year last year. So that's really dragging down the 3-year.
When were their management changes? When you were there?
About 2.5 years ago.
Yeah.
Right.
You must have had a great year 4 years ago, 5 years ago. They must have been really strong then, like,
They had an incredible 2020
Yeah, they had a big 2020,
that's what it was.
Yeah.
and a pretty good 2021 as well.
but they did have a change in management,
Yeah,
They did.
and that might be reflected
in the numbers as well.
in the numbers now.
Right.
Yep, so whether that is in the spring or in the fall, I think, you know, given the performance is now not just a 1-year trailing period, we should keep a close eye on them and have them in again to present to the board. Within international, you can see Silchester's has done a nice job. Kevin was actually at their conference this morning, getting an update from them, and you know, despite their more value-oriented strategy, they've done a nice job. Walter Scott has underperformed in the fiscal year period. That's largely driven by when Norwalk entered the fund the spring of last year. They've done a really nice job since. And year to date, they're up about 4% through February versus 2.4% for the EFA index. So they had a solid start to the year and a pretty good fourth quarter. So we expect them to bounce back versus those benchmarks. BlackRock EM has done a good job. You can see a strong outperformance for the fiscal year. And ABS, your remaining global equity long short manager, has also performed well, particularly over the last year. You know, we expect that return somewhere between stocks and bonds, and that's really right where they're sitting in a differentiated return pattern.
How much of the emerging market is China?
So this strategy, I think in general, it's about 30-ish%. This strategy tended to be a little bit overweight. They're not taking huge country or sector bets. But that hurt you can see it over the 3-year period. That overweight to China, when China went south about 24 months ago, hurt them initially, but I think they've, you know, tried to stay away from some of the real estate names.
Are other countries negative as well?
Yes.
In EM, I mean, so just for perspective, in January, the MSCI China was down 10% and the MSCI EM was down like 4.5%. So I guess you could look at it two ways, is that the index is still diversified, but that 30% weight is yeah. You know, I think one of the things, and actually it was interesting because just with Silchester today, because they do still have, call it like 10% EM exposure, but they reduced it by 30-40% over the last couple of years, in large part because of the reduction in China. They're also looking at you know, their Taiwan exposure, because has that become like a China play as well, given everything happening there? And you know, everybody loves to talk India, but at least from Silchester's standpoint, the numbers don't necessarily support all like the growth that's happening there. And same thing with Brazil. So the EM story largely has shifted, and it's not the powerhouse that I think
Hmm.
It was obviously 10, 15 years ago. So I don't know if that helps.
Yeah,
answer
no,
the
I don't
question at all.
know.
Does everybody, do you get the Silchester monthly report?
I don't know, I might, I probably do. Yeah.
And,
Isn't it supposed to be sent to everybody? Do you get it?
yeah, Korea, I think is gonna become part of
You
the,
know,
South Korea, I think they're talking about maybe moving out of EM.
And into just international in general.
I think so. So that could be interesting.
Okay,
And where are we in terms of our allocation for emerging markets? Was it 3.83%? What's our target? Or 3.9?
yeah, so Silchester and Walter Scott only invest in developed markets for the most part. They might have out of benchmark allocations to emerging, but for the most part, they're investing in developed international markets. So the idea here is to have them dedicated to the developed markets and then BlackRock dedicated to emerging markets. And the split roughly is it about 70-30
For,
developed to EM in the international markets?
I don't even think EM is that,
I think 1820 probably.
yeah, I don't think it's that high,
19, it's 19.62% versus 3.93% on targets.
right? Yeah, I mean, within this, but to your question, direct EM exposure is a little under 4% with the
Yeah.
BlackRock.
Yeah,
And you're not gonna, Walter Scott typically takes very little as well.
And you could get, it's the old question though, like you get EM facing.
yeah.
So all the international companies that sell Chinese consumers or emerging market consumers, it's tough to say exactly
Mhm.
in that respect, but in terms of actual strategies, it's just the BlackRock.
And we think it's meaningfully enough sized, it represents, you know, a reasonable allocation within the international portfolio to get you the exposure and diversification, and it's at 3.8%. If emerging markets shoots the lights out,
Mhm.
it's gonna
We get something.
benefit the bottom line.
Yeah.
Whereas if you reduce that to 1%, the reality is it's not gonna affect the total fund
Mhm.
at a level that is worth having. And then finally, on the last page, fixed income, you know, we heard from Metropolitan West TCW a few months ago, and you know, they had a great fourth quarter given their duration positioning, so it was good to see them bounce back in a environment where rates came down a little bit. And Prudential, who's a much more conservative bond fund, has done a very nice job over the last year. And then you can see UBS, I mentioned earlier, has done a nice job in their differentiated strategy, and PIMCO All Asset has also done very well. So 5.9% fiscal year to date through January.
You know, when you look at the domestic fixed income over the last year, you're making 2.2%. I mean, the 10-year pays 4%, 5-year pays over 4%. So I don't know who that say their performance, why would you say their performance is that good? I mean, they.
From a relative perspective. And I think the expectation is, you know, they are a little farther out in the curve, and you can see your cash portfolio has returned almost 5.5% over the trailing year. But being out in that 6 or 7 year duration, going through 2022 and 2023 with rising rates, we would expect on an absolute basis where rates are for them to not keep up. But when rates come down, assuming they come down, we would expect them to outperform cash. And if the yield curve normalizes out of its current state, we would expect them to be rewarded.
And that's what happened in the second half of the fourth quarter. I mean, we went from a negative return in fixed income market up to that point to all of a sudden rallying to a positive finish for the year.
Yeah, I think the ag was up almost 7% in the fourth quarter, which
Yeah.
You're 1.27% for 7 years.
It's been
Correct.
a very
Yeah,
difficult market.
yeah, you had 2
to own
years of
bonds.
historically poor returns.
See, what's interesting about that though, too, is that when you look at the count assumptions for like the market, capital market assumptions, then you look at core US fix and it was a 10-year geometric is 5.25%,
Mhm.
right? Which is, much higher than the 1.36,
Yes.
right? And I don't know how you calculate that, how you really come up with that, but that's a key difference,
Correct.
right? When you look at those two things there, and that would affect your decision making, say, okay, more fixed income or less fixed income.
Because they're forward-looking projections, right?
Yeah, I understand,
Yeah, and we were in a zero rate environment.
for so long.
Yeah,
But if Cal is predicting 5.25%,
Yeah,
10-year, then this portfolio is gonna lose money, gonna make money if you're out on the yield curve, right? If you're out on the yield curve, you got bonds that are 4.5%. The 10-year right now is 4.15. And if rates are going to 5.5, there's gonna be a loss of principal until maturity.
Well, I think our assumption assumes a normalization of the yield curve, where the rates on the front end are going to come down, the yield curve will be upper sloping over the next 10 years. And when rates come down, that starting yield right now, we're already here, we don't expect rates to go up, is going to affect the long-term return of core fixed income.
Okay, I don't disagree with you that the yield curve is gonna eventually normalize. But if it normalizes because the 6-month bill goes to 3% and the 10-year goes to 5.25, that would be a normalized yield curve. But if we own the long end of the curve, then we lose money because as the yield curve normalizes, the 10 years or the 7 years that they own now are gonna go down in value, right? If rates go to over 5%. I know they do. I mean, it's pretty simple.
yes, you're saying that holding 20% of your portfolio in that area there, and if this does come to
If they're
fruition,
correct,
then we would see a decline in
right,
our asset.
right.
Is that what that table said? I thought if the long-term rates,
No, if the
Drop by.
rates drop,
couple 100 points, then, we win.
correct.
I agree with that.
Okay.
I agree with that.
And win more in the 2-year.
Yes. The longer you're on the curve,
Right,
the
right.
better the return. And we'll walk through our capital market assumptions with Rick, who's on the phone.
Is he here now?
And that was the biggest change to our assumptions this year.
Yeah,
And Rick will walk through why our core fixed income changed so much and our outlook and, why we think that fixed income now, after what we've been through the last 2 years, is a place that could actually
Which should be
return
good,
more than
more.
5% and still be a diversified, less risky asset than some of the other asset classes.
Hey, Britt, I finally got connected, so good to see everybody again.
Rick,
All right,
thanks
Rick.
for joining. Frank, do you want to jump into the asset allocation?
Yeah. Yeah, let me share my screen here.
I'm all set if the board
Yep,
is all set.
yep. So we're gonna go back to asset allocation review.
Ready. All right. Can everyone see my screen here? On the cover page, so.
We see a zoomed in version.
I think.
Yeah, how about that? All right, let me see if I get this other thing out of the way here.
We should all have it, Rick.
I think we've all got it here.
All righty. Can you, everybody see it now? Are we good?
You're good.
All right, awesome. All right, so, a lot of this will be is familiar from the last time we chatted. So, we're going to talk about the CMAs, your existing allocation, some alternatives to consider, and then, what we think, some things for you to consider as action items for today. So, so this is Britt. Do you want to cover this? Because this is more of the historical stuff.
Yeah, we-
and you've got the institutional knowledge here.
Yeah, we wanted to add this page, one for Bob's edification, and just to remind the board that, you know, every 3 to 5 years, or if something changes, we review the asset allocation, and the asset allocation is, you know, going to drive the majority of performance for the pension plan. The managers that we discuss and you pick, there is alpha opportunity there, but in terms of, you know, what's really going to drive long-term performance, it's the amount of equity risk you're taking within the asset allocation. So as a refresher, you know, the last time there were changes was 2021. If you recall, we reduced private equity in half from 6 to 3% to really represent the long-term distribution of capital as these private equity funds roll off. You know, right now there's a slight overweight to private equity, but as these funds continue to distribute capital, we expect that to come down over time. Real assets used to include private infrastructure funds. So the target there was 12%, that was reduced to 6%, and PIMCO All Asset is the only remaining allocation within the real assets allocation. And then you can see we increased domestic equity and a little bit of an increase to international equity. Importantly, when these changes were made based on Callan's risk and return projections, you know, while we reduced private equity, we increased public equity, and overall the long-term return assumption and risk assumption were largely the same. As you know, 2 years ago now, Blackstone was terminated from the global equity long-short asset class, and that capital has largely been distributed. There's a tiny remaining balance that should be liquidated in the next 6 months. And given that you have ABS, and based on discussions, there was no desire to add another manager to the asset class, we think that revisiting the target of 8% is reasonable, and where to put that 4% that was with Blackstone in terms of the target asset allocation. So our hope today is really to take a look at the current portfolio, review our capital market assumptions, where we think our best guess to where returns are going to be. Again, these are not scientific. They are, you know, we take in a lot of knowledge, and Rick can talk about it in terms of how we come up with these assumptions. But over the long term, you know, we feel that they are reasonable and use them for all of our clients in our asset allocation work. And then lastly, I think we all know that the discount rate is currently 6.5%. It's come down 1/8% a year, which is great. And that's the expected long-term discount rate at this point. So with that, maybe I'll turn it over to Rick, who can walk us through, you know, the asset allocation process, as well as some of our capital market assumptions and why we're thinking, you know, for instance, fixed income, a better looking return going forward. Rick, do you want to take it over?
Yeah, we're not hearing,
He's muted.
we're not hearing you, Rick. No.
No,
Maybe Rick doesn't want to take it over.
he's not.
How about now?
There you are.
There we go.
Keep going here.
We do hear you now.
Take off your earbuds.
All right. Can you hear me now?
We can hear you now. Yep.
All right. Beautiful. Technology just got thrown in the trash. So, all right. So as Brett indicated earlier, there's been tons of studies that have been done that shows that asset allocation is the most important driver of your long-term returns. You all know that. We don't need to spend a ton of time here. We try to keep it high level at the main asset classes, large cap, SMID, international, that we don't go into growth and value here. That's another, that's another peel back of the onion, if you will. when we do these studies, we try to look at your plan, your demographics, everything, your discount rate, your funded status, all those things. So there's no one size fits all solution, right? And so we want to customize your allocation as best we can so that it meets the needs of the trust, right? So this is a page that we use to kind of show where the investment policy sits in with everything on the plan. So if we start in the upper right-hand corner, right, money comes into this plan. And so, and like with most plans, especially public plans, there's this thing called the actuarial determined contribution. So it's the normal cost plus the amortization of your unfunded liability, right? And you close the amortization 2021, so so that liability, that liability is going to be gone in 15 years. And last year, I think you put in about $15 million of contributions. We don't have the updated VAL report, but it's probably somewhere around $15 million again. So that's good. So you have money going in. You're about 35 million is going out every year. So what that tells us is that you should expect to sell securities to pay for the benefit payments every year, maybe about $1 million and change a month. That's what the trust is there for. And so when we think about that, how important is liquidity, right? Well, it's pretty important that you can get to the assets to pay the benefit payments when due. One thing that we want to try to minimize also is what I call regret risk, which is where equities have just tanked and now you have to sell those to pay for benefit payments instead of allowing them to rebound, right? And so that is going to be one of the things we'll talk about later when we get to one of the considerations about moving more assets into fixed income. Okay. Then the existing policy that's here up on the upper left-hand corner. It's very solid. It's a very solid policy, and that 3% in private assets is the end that's in runoff mode. So that'll eventually go away and go to zero. So like I said, we focus on the high level asset classes here. And so let's talk about our assumptions on page 9, right? The assumptions, we talk about long-term averages here. So these are 10-year assumptions, not 12 months or 18 months, right? So if we were having 18-month assumptions, they would be significantly different than what we're about to show you. The process would be completely different. And to be honest, I'm not even sure how we would do that. We sure wouldn't do I don't think we would do much of what we do now would translate over to a shorter term assumption. Okay. So this is a snapshot of your asset classes that you invest in versus the assumptions that are in the center where it says projected returns. And then on the far right, where it says 2023 to 2032, those are the assumptions from last year. The general rule, your equities are up 25, 30, 35 basis points, and your fixed income is up a full 1%, 525 versus 4.25. And then with respect to the alternative asset classes, it's about 25, 50 some odd basis points. And that's just a result of the same reason that the equities are up, a little bit. So we unlocked the valuation assumption, and then also when we break down our equities, we'll show that a little bit later how we build those out. Some of those same factors that apply to the alternatives as well. So any questions here? Is that it kind of the high level? Okay, perfect. So I want to walk through the fixed income assumption where we were 2 years ago versus now, and I think this will help frame some of the discussion that we were just having about 10 or 15 minutes ago about yields, where they are now and what we think is going to happen. So when we build out our fixed income return, we start with the existing yield curve. So this was the yield curve at the end of 2021. And that number there at the far right, that 1.75, that was our return assumption for core fixed. And why was it so low? Well, because this orange line, that was our equilibrium. And so we had the yield curve rising up from the blue to the orange over a 30-year period. And so every year there was going to be a little bit of a capital loss, just like you said earlier, right? When rates go up, there's going to be a capital loss. So the coupon income was still there. The roll downs were still there, all of that sort of stuff, but we're just taking a little bit of a hit every single year as rates were, as we assumed rates would rise. But what happened in 2022? Rates jumped up. And that move there is about a 1 in 2.5 million event based on the standard deviation. So we took 25 years worth of of pain right off the bat. And so if you remember, the return for 2022 in fixed income was negative 15%. Right. So we took all of those little death by 1,000 cuts, we took them all we took a good chunk of them last year. Now, because rates were higher, we could also assume that we're going to get a bigger coupon going forward. And so the return assumption jumped from 175 to 4.25. And then fast forward one more year, right? And what happens? Well, yield curve of the longer end is now at equilibrium, right? So we've taken on all 30 years worth of pain. The yield curve is still inverted. And so down in this area right here, right? You know, if we believe that the yield curve is going to drop down here, right? This is where you kind of want to have your investments in that 5 to 10 year, 5 to 10 year and shorter period, because you'll get capital appreciation. Now, if we're wrong, and inevitably we are, if we end up with an equilibrium or short term where rates pop a little bit, then yes, there will be continued capital losses over time. But this is how we've gotten from a return 2 years ago, 175, to one that's now 3 times as much, 5.25. Right. So we've taken a ton of pain in fixed income, right? And now it's actually a viable investment class. And we got a slide a few pages later that show you that you can actually achieve your 6.5% return expectation going more than 60% into fixed income. So you just don't need as much you just don't need everything sitting in equities now to achieve your return objectives anymore. Fixed income is now a viable asset class to invest in again.
How do you get to the I guess the thought that equilibrium is at 4.5% or so? How do you get to that as opposed to it being somewhere around 3% or 2.5%?
Right here, this 4.25.
Yeah, how do you get that to be equilibrium as opposed to a lower number?
Wonderful question. So that we're hiring. So if you're ready to just take over and do this slide, we got you covered, man. So this is our bond model. What we do is we start with the income, and so we'll just look at the aggregate here. This is your core fixed, right? We assume that there's going to be 4.7% in income. We do think that rates are going to drop a little bit in that end, so you're going to pick up an extra 40 basis points. And then there's always defaults when you invest in credit, so that's the 10%. That's a 10 basis point drop. And then this is extra yield you get from investing at the 5 years. It rolls down to the 1 year period. So that's how we got our 5.25. And so if we look at the 4.25 numbers, we'd have a little bit higher in the capital gain would probably be a little bit of the capital loss, and the income was probably a little bit smaller. That's how we generated these numbers.
Rick, how much of that is already baked into fixed income prices?
When you said how much of that, what do you mean? What is that? Sorry.
I mean, if everyone else has the same view, they're going to be buying bonds, right?
Yes. So is there like a supply demand component to this?
Yeah, right. That's what I'm asking.
Yeah. I'm going to answer a different question. We're seeing a lot of our clients move more assets into fixed income. Okay. This is a common thing that we're seeing, and it's not small shift. It's 10% plus that we're seeing. Because they're saying, they're saying to themselves, we're kind of buying low in a weird sort of a way, right? We've taken all this pain from rates rising. Well, now we can get 5%. Right? We get a 5% yield on our core fix. Why wouldn't we do that? And that equity risk premium, right? The difference between your core fix and the equities, it's in its tightest band that we've seen in a long, long time. I think for us, it's 225 basis points. And in full disclosure, right? We run our model separately. So we have an equity model, and originally that came up at around 7.25. We had the ag at 5.25. And that 200 basis point spread created a lot of problems for us to get all of our asset classes to optimize. And so one of the things we said is, well, what if we take the equity assumption up another 25 bits? Then a lot of the internal machinations of the math worked. And is it going to be 7? Is it going to be 7.25? Yeah, probably. Or is it going to be exactly that? No. But I can argue either way. And that's kind of that, that's a little bit where some of the art comes in on these things.
If you think short-term rates are gonna drop significantly, right, and yield curve is gonna normalize. I mean, if you think rates are going to 3%, why wouldn't you buy invested? Don't you think that would help stocks like, say, Exxon that pays more than 3% and they've paid a dividend they've never cut their dividend in 40 years or something like that, or Johnson & Johnson, AAA rated, better than the US government, and it pays like 3.5%. And it raises its dividend almost every year. And Verizon pays 6.5%, and probably everybody in this room has got a cell phone, and probably half of us use Verizon. So don't you think that lower rates, unless there's a severe recession, lower rates are going to be beneficial to the stock market? The stock market,
Absolutely.
you guys have been, we've been in bonds because we have to be prudent men. And everybody, you, Charlie, will know this longer because he's been on this board, and I've said they're just not very good. And for 7 years, we've gotten 1.7% for 7 years. That sucks. Okay,
Yep.
that could be on the record. So, and now we're talking about the Fed. I think the Office of Management and Budget, if you look at their assumptions, one of their assumptions are, because they say the deficit is going to decline a little bit, is because they're assuming that the tax cuts in 2025 are going to go off. And if they don't go off, it's going to add another $2 trillion, $2.5 trillion to the deficit. Okay, so the deficit is already $34 trillion. The 10-year had one of the lowest numbers of foreign buyers yesterday. What I don't understand, this idea that these bonds are a great idea. And the other thing is, personally, if you look at the CRB index for commodities, it's up 9.5% year on year. Oil's at $78. So there's still inflation in the system. We just saw that in the numbers that came out 2 days ago. The Fed's not getting back to 2%. I mean, so why bonds? I mean, you know what, to me, buying bonds is like saying, well, the steel stocks really suck. They've been really going down for years and years and years. So we got to buy these steel stocks. And bonds have been a poor investment for many years.
They've been a terrible investment for the last 2 years and 3/4. I mean, the only thing that saved us from having three straight years of negative returns was fourth quarter of last year, right? Right, we were on track to have 3 straight losing years in the fixed income market if rates didn't fall in the fourth quarter of last year.
If rates didn't do anything, if it didn't rain, we wouldn't have crops. But the reality is this: for 7 years, if you look at our performance, in fact, in 7 years, if you look at cash, outperformed.
I don't think anybody is debating that they haven't done well. I think everybody completely agrees with you, but I also don't think that you can invest in a rearview mirror. Because
we're not, you don't think that people, I mean, excuse me, to me, you look at a chart and you go, technology looks like it's been doing pretty well. So people put money in technology. Steel stocks didn't look so well. You don't put money in it. Bonds haven't done well. They haven't done well. There's no reason. You guys have guessed in the past that this could be a good time to invest in bonds, and it has consistently been a bad time to invest in bonds.
I don't know.
That's all.
We've been
Your
guessing.
track record investing, your track record for talking about bonds hasn't been good. We're in them because we have to be prudent.
Yes, you do have to be, because of
But
the
to
nature.
add to them, that's.
The nature of the plan is that you have to pay benefits. And so if there's volatility at any point in the equity market, you don't necessarily want to be, even if your equities are outperforming over the long run, which they should be doing, they should be outperforming your fixed income. But you don't want to be selling at periods of volatility. You want to be able to draw from other places and have a buffer. And I understand the last 2 years were historically bad in fixed income, but I don't think that's the basis for, making decisions for the next 10 to 15 years either. I think there has to be diversification aspects. And we're talking about with the ag, you're still getting the overwhelming majority of it from the income component. So it's not
That's
necessarily.
an assumption, that's a guess.
These are all assumptions.
Right, but that's a
Everything,
guess.
the equities are the assumption.
Right, and how
too.
many people said the Fed was gonna cut rates? The average was something like 6 times this year. How are they doing? How many people last year said they were gonna cut rates? And they didn't, they continue to raise them. When you look at what people said in 2022, they weren't saying, oh, rates are gonna continue higher. So they were wrong.
That's why these are normalized assumptions over the next 10 to
Okay,
15
so-
years. They're not necessarily based on, we're not making predictions on how many rate cuts are gonna happen in the next 12 to 24 months.
Yeah, so if they
So
don't have,
what would you want to do, Frank?
I just don't wanna add, when he talks about maybe adding to 40% of bonds, look, the bonds that we have, that's fine. They're within our parameters. One of the things we do is we do have, we aren't in the situation where things like, we don't have like private equity. One of the things we've done is we've scaled that back because then we're not gonna have to worry about capital calls and things like that. So that when in the past, when 08, 09, when those things were happening to others, it didn't happen to us because we didn't have any demands on funds outside of paying pensions. Because a lot of places,
I'm
they,
inclined to agree completely. I wouldn't want to put any more at the bottom.
right,
Given the history, given the projections that I keep seeing, one thing that stands out, looking at this, you give them 2 proposals. One is to put 4% into bonds, one is to put 4% into equities. But your projections, and I hate to say this, real estate does better than both of those. Why aren't you recommending we go into real estate? I mean, I would say no, given the history of the board. I mean,
Right, and then look-
before any of you guys were here, we took a real beating.
meeting, right. No, I was,
But, just based on what your numbers here say,
Well, you're not just going after the highest return.
why not?
Why? Because then you would have everything in private equity. If you had no sort of
No,
restriction.
no, because you still have to assume that,
Did we just lose?
I think you might just move the mouse.
Just mo- Hello?
We hear them. They're there.
Rick, are you there still?
Yeah, I'm still here.
Okay, we
Can you hear
lost
me?
you. That's okay.
There's a multitude of things that the model is looking at. I mean, it's running
and we
10,000.
still have to have a prudent investors look at this. So
Correct.
We need a chunk of money.
Right, and we also need to take
We need
into,
everything else diversified.
we also need to take into account liquidity aspects. So
Yeah.
there's lockups as we know all too well in the real estate market right now where you can't get anything
Yeah.
back. And that's not something that this particular plan can afford to necessarily deal with. So we can't just, lump into illiquid asset classes blindly, simply because they have a higher return,
So you have a reason for not going to real estate, but why is there a reason for not going into equities?
Or even, the question may be is, with an absolute return, the UBSAS and also PIMCO all asset, and like they're both return risk profile there, and how that compares to the fixed income. And
Correct.
is it, does it in some way hit a different kind of chord there that we have a history of seeing better performance, but also.
Correct, but that's only, all of that is based on whether or not, and everybody is more than entitled to their own opinion, whether or not you believe what our assumptions are saying.
Yeah.
Such that you don't need to take on greater risk or volatility. We believe that you can do that in the fixed income finally
Mhm.
for the first time in many, many years. And therefore reduce the overall risk of the portfolio while staying liquid
And I think
And
Kevin
getting a
hit
good
on it.
return.
and getting a return.
Return.
And Kevin hit on it a little bit. One thing we haven't discussed is the risk. and the
Yeah.
volatility inherent with public equities, certain kinds of private equity, real estate. There's a risk associated with each of our assumptions.
Mhm.
And when we look at our assumptions, our forward-looking, we look at the funded status of the plan, we look at the discount rate. Is there a way to achieve your discount rate with less risk?
Yeah.
And that's where we look at fixed income, where we are today, what we've been through. Going forward, we believe for the amount of risk you're taking, fixed income is a reasonable place to put funds to work, where they are going to diversify your equity exposure, which is largely public equity, which is very volatile. And we don't know whether the markets are going to go up 20% this year or be down 40% next
knows?
year. And with the asset classes in the plan, how can we make sure that the diversification is there so that, you know, in a down market of equities being down 40%, where is the diversification and the risk buffer to be able to draw those benefits and not have the total fund be down 35, 40%, have it be down 8 or 10%? Because the path that you get there with the actuary and determining what the city's contributions are is a big part of that return. It's smoothed over 5 years, but if you take a lot of equity risk and you have 3 of those 5 years double-digit negative returns, the city's contribution is going to be significant.
Mhm.
But if that's the assumption, then you're saying we shouldn't put anything into equity. We should put it all into,
Right, but you know,
if that's your concern.
right,
But you're
But wait,
underfunded and you need
You still need growth.
you need growth.
okay, but you know what's, one of the things you said, so the history, my history in the bond market is that I moved to Chicago in 1977 because they started the bond contract. The 8% bond was traded at 102. Okay, the contract, it went to 48. The bonds lost over 50% of their value. So maybe the stock market was down 40%, but maybe the stock market was down 40% because there's a crisis in the bond market. So you're making this assumption like, well, stocks go down, bonds are fine. But there's a lot of risk in the bond market. We're
Totally
just seeing, for 7 years, we've got nothing,
Totally agree.
basically.
And we've
So-
seen correlations.
So,
Increase
so,
significantly.
I'm gonna make a counterpoint here to that, to your argument, because you're saying, what I think I heard you say was that when equities go down, that also causes issues in the bond market.
no, I did not say that. I said.
Okay,
there's a
thank
possibility-
you. I want you to clarify it, please.
But let me clarify it. I said that stocks could go down, but one of the reasons why stocks could go down is because bonds went down.
Yes.
Sometimes I'm hearing from you that, well, stocks could go down, but we're safe in the bond market. Bonds can lose half their value. That's what I'm saying. I lived through it, okay?
Oh, yeah.
Okay,
Yeah,
so please don't be telling us that bonds are much more, oh, they're good, they're fine. There's a lot of risk in the bond market.
Yes, there is. However, when we go back to our assumptions, right, and we look at our, you know, just bear with me here, right?
Rick, can you tell us
I'm
what
gonna-
page?
That's on page 10. Right?
Thanks.
So as it stands right now, right, our return on bonds is 5.25 with a vol of 4.25. And for the equity side, your vol is 4 times as high. It's, 17 to 20%, and you're only picking up an extra 220 basis points, 250 basis points, if you will. Right, and so that's a lot. That's a lot of volatility. Granted, you will not get an argument from me that moving away from equities, right? The equities is the highest expected return asset class out there. Right, and it tends, it's also the most volatile, but equities tend to go up over time, and we've seen that in, this chart I think illustrates it really, really well. Let's look at the return in 2022, right? Terrible return, negative, whatever that number is.
What page is that on?
Page 15. Page 15. Sorry.
You lost your video, yeah.
Yeah. So
Yeah.
negative 18% in 2022, 2023 plus 26. Right?
Yeah.
2018 minus 4, right? 2019 plus 31. So the market tends to be very volatile. So you get big drops, big swings back up, right? You don't necessarily see that in the fixed income market. Especially these things, rates have been bouncing around, so we will see that. Right, but it does provide you a better preservation of capital, right? And it should act as your anchor. But you are correct in that the more you move into bonds, right, the less your expected return will be. However, it should give you additional stability in times when you need it, right? So when the equity market goes down, and it inevitably will, right? And you have to now sell securities to pay for those benefit payments. Having a nice pot of fixed income allows you then to access that and give those equities a chance to recover. I think that is the argument that I would make as a pension manager for increasing the amount in fixed income slightly.
Of the 4% increase in fixed income that we're looking at.
Yeah.
How much what's that in relation to the outflow that we're going to, the net outflow we're going to see for the amount that the fund's bringing in versus what it's paying out?
I mean, the reality is you've already received the Blackstone redemption in large part, and it's been used to pay benefit payments. In terms of what the actual asset allocation changes needed to move to increase that, I think it's, given the policy ranges, it would be marginal over time on how much you increase that or where you increase that. It would simply be.
Yeah, the point I'm trying to make is if we're talking about 4%, is that covers how many years of benefit payments?
Isn't the answer, was it 15 million a year, basically, is the outflow?
About 35.
But we're putting in 15.
4% is about, if I look at the private equity line here on page 19, 4% is around $20 million, right? So it's, you're talking about.
We're talking about 4%. That's not even a year's worth of payments going out the door.
That's
And
correct.
so I think we're getting, we might be focused a little too granularly on the importance of this decision of whether it's 4% or 2% or 0. It's.
Yeah, I think I know where you're going.
The idea that we have an opportunity now to reduce the risk exposure of the plan at a modest cost.
Well, if you think about it, if you look at the last time we did this was 21, wasn't it, or something like that? And 2021, and I remember looking at it, because I even said to you, your assumption was like 2% inflation over 10 years. Well, okay, so 4 is a little higher, 6 is a little higher. I mean, to me, had we moved more money into, say we moved 4% more into bonds then, all right?
Mhm.
How much would we have lost? Rather than making 7.5%, 8% in the stock market. In fact, over the last 5 years, it was I think it was 12. So let's see, 12 instead of 1, we made 11% more.
We're arguing about it. It's like somebody saying that the risk of cancer goes up by twice and the cancer rate's only 1%. Big deal. Or 10, it's not we have to talk about levels as well as percentage increases here. We're not talking about taking $50 million and putting it into bonds.
Right, but even
We're
if we
talking
did,
about
Is your bottom line saying then put the 4% into cash and don't worry about it? Is that what you're?
my bottom line is that we have to go beyond just looking at the potential return and the potential return we're giving up. And we're, you know, it'd be, you know, we could have the same argument about whether our allocation to small cap equity has been good or bad. We could have the same argument because those have sucked worse than bonds or as far as those have lagged versus the broad market. I mean, we can have this discussion about a lot of things, but the point is that what bonds give us is that it gives us a place to go get some money if the equity market goes into a shitter. And then, you know, true that bonds
Well, let's
go
go
into
to
the shitter too. And we saw that last year.
But that was
So-
the standard
so-
deviation event that.
Oh, I
Right,
understand,
right,
I
and I'm
understand
not
that.
saying it couldn't happen again, but.
Yeah,
right,
yeah, yeah,
And we're so, it's 70% of the portfolio in equity, and there are so few spots that this plan can diversify into beyond that at this point. So you're right, we're talking a very, very small magnitude to give us some greater diversification, reduce the overall risk portfolio, and ideally, it would be
Really
create a
not
smoothing
lower our
effect.
potential return all that much.
Right.
Yeah,
Does anyone, any of the Callan folks here, know, if you look back over history, I don't know what the period is, 20 years or so, how often have equities and fixed income both been negative for the year?
correlated.
I think it's 2 or 3 years in the
Yeah, I've got
last
that for you. Brett.
60.
It's out of the last 100 years, it's been 3 times on an annual basis,
3
but
years.
on a quarterly basis, it's about 10% of the time.
Right, but we shouldn't be.
So we're a
focusing on-
little overplaying the last 2 years.
Right.
Correct.
Put it here and there.
so say we move 4%. Like I said, the last time we were here, we did this in 2021.
Yeah,
We had $500 million. So we moved 4%, okay? So the 3%, so over the last 36 months, income from our bonds was minus 3.28%. Income from our stocks was 7% or.
But you're capturing
Can I
the,
finish?
That's
Please,
that's
can I
why I
finish?
just asked the
that's why he
question.
asked that
You're
one.
referencing,
Right, so
3%
what I'm saying
probability.
is, I don't think so. I really
Okay.
don't. I mean, you know, and the other thing is nobody's talking about is when they're talking about being on the curve, oh yeah, being on the 5 to 7 year curve. I bought a 5-year recently in the secondary market that had a coupon of 0.50%. Tell me that there was some capital appreciation, number one, and number two, what was your return over 5 years? 0.5%. That's reality. And if the difference between the stocks and the bonds would have been roughly 10% on $20 million, right? So that's like $2 million a year. I think that's a reasonable amount of money. Maybe you don't, but I do.
no, I think that I think it's too easy to just take periods of time and move the goalposts to support any sort of argument. I mean, if we had been talking fixed income versus equity in 2010 or 2009, right? Like it would have been a different conversation just because of what recency bias and what, you know, to Jim's point, what Rick supported. I mean, that was literally, we got 2 years back to back. And it only happened one other time in the last 100 years. So I really don't think that the last 3 years are a good indicator of what has played out historically, because statistically it proves it. So I just don't think we should be focusing on such a short time period for a plan that is designed for a much longer horizon.
Okay, I'm gonna go back 18 years, because Charlie and I have been on this board for 18 years. I've been on the board for over 18 years, and Charlie was on here. Charlie, have we always been negative about bonds?
Yes.
Yes. Has it been a good plan? Yes. Okay, so we're not talking about short term, we're talking about 18 years. And if you look at one of the things is the performance in the OPEB, one of the things is, it's very simple. We have more money in, it's more overweight in stocks than it is in bonds. And which one has outperformed?
I don't,
Has
but,
OPEB
no, but,
Excuse me, can I finish again?
sure.
What is outperformed? Has OPEB outperformed or has the regular fund outperformed? OPEB has.
Just to be clear, I don't think we've ever would expect bonds to outperform equities. That's just not how the two asset classes are. So we're not ever gonna be debating that bonds are gonna be outperforming equities. But I would suggest in the last 18 years, while maybe front to back, you haven't felt that bonds have been a good asset class. They have served purposes for plenty of plans along the way in a very healthy manner. And again, in that 18-year period, we would never expect for bonds to outperform equities. We're not comparing the two. The reason you own both is because on the whole, historically speaking, they are diversified and uncorrelated, except for 3 out of 100 years.
Okay, so can I ask you a
The
question?
correlation, according to your table on page 28, the core fixed income with the broad US equity is 0.08% correlation.
Well, one of the
So it's
things,
a huge diversification.
And in times like the
Where
last
else
2
you gonna
years,
go?
we've seen
I
it
mean, you have
spike.
real estate's 0.34, equity is 0.8, hedge funds is 0.6, global ex-US is 0.79. Where else you gonna go?
why are we going anywhere? Why are we not staying?
Well,
where we
I
are?
mean, that's what the discussion's about.
Right, and I'm saying, why are we gonna add the bonds? One of the things you just
Well,
said.
why we're adding the bonds is because that
Least
8 basis points of correlation.
Well,
I mean, and cherry picking the last 18 years where we're coming off of in the 80s and the 79 and 80 inflation, that's a little bit of cherry pick.
no, that's not 18 years ago. Excuse me, that's not 18 years ago. I came on the board.
Well, but anyway, it was.
No,
it was-
that's a
it
big
was-
difference.
It was,
From
it
the year
was,
two-
in- it
From the year
was,
2000 on, from the year 2005 on, when I came on this board, bonds have consistently underperformed stocks.
that downtrend started in 82,
Yeah, it started in 82 when,
40
yeah,
years.
well, the trend, I mean, what happened basically is when the election of 1980 and 81, they jammed rates up to 21%.
I know,
Right, so that was, and if you had a bond portfolio, then you got destroyed.
that's right.
Right, that's where bonds lost over half their value.
Mhm.
But what I was just told is over the you would expect over 18 years that stocks would out.
I don't think anyone else put 18 years,
I
no
don't-
one else
He
put an
used,
18-year.
he said 18 years. We'll go back if you want to listen to it.
Okay,
Okay, and you said that over that 18-year period, you would expect stocks to outperform bonds.
Yep.
Right? You said that. So if you feel that stocks are gonna outperform bonds for 18 years, none of us are probably gonna be on this board 18 years from now, but the portfolio will do better because it's got more money in stocks than in bonds.
but the definition of better is just not based on returns.
Correct. The most
You
well-funded,
gotta, you gotta look at the amount of risk we're taking.
And it's not just an 18-year, right? We have to have a balance 5 years from now, 8 years from now.
We're just not gonna make 6.5% if we got more money in bonds.
We're not gonna make, it's,
The bonds have been a drag on the portfolio for years.
Just out of curiosity, on that,
I mean, realistically.
I would say that is,
Do we cut
yeah, that's a tough statement.
in the 90s, you could construct a portfolio that would return 10% with all fixed income.
we've got a great chart
You can't do that anymore.
Right.
And so is our discount rate, our discount rate at that time was what? Was it, it was under 10%, right?
Our discount rate for the,
Yeah, go to, page 16. You
Yeah.
know that one I'm talking about? Yeah.
Or what page?
So
Wait, wait, wait.
realistically, the reason why we should.
Hey, I hate to do this, but I only have about 5 more minutes.
Logic to say
Okay.
that we should go for a high risk asset because we gotta make our discount rate. Is that the question is our discount rate too high?
no, our discount rate isn't too high, it's 6.5%.
It should be, should it be 3%?
No, because it was 3%, we'd just buy 30-year bonds paying 4.5, and we'd be outperforming would be outperforming by 50%.
And so we're not doing that because we
Right.
want to take more, in order, we have to take more risk in order to make that
And what
discount.
is so since we're talking about bonds, what was the average return in the stock market over this period of time? Over the last 30 years, over the last 40 years? 7%?
I'm not sure what you're,
There's a period of time in the 70s where stocks
Yeah.
returned nothing.
we
I know
went
that.
from, but
And
we,
there was a period of time when the bonds virtually returned
but
nothing.
we were in a declining rate environment since 1980, and we're
82.
finally now at the point where rates are rising. We did get that standard deviation event, which Rich talked about, in the fact that we got 30 years worth of rate increase essentially in
Last year.
12 months, 18 months. And so, you know, that's what's magnifying it, but we're finally in a rising rate environment where we can actually get something in the fixed side and reduce the risk for the same rate of return for the portfolio.
There was a meeting with Federal Reserve once where they raised rates. They put a premium on all the big banks of 300 basis points. So to tell me that we did in 1 year what they did in X number of years, go look at what rates did from November of 1980 to January of 1981. They went up by like 800 basis points, okay? So that can happen. I'm not saying it is, I doubt it would ever happen again, but it could. And all I'm saying is that the portfolio seems to be doing well. We're not having years where we're way outperforming and then we're way underperforming, right? We're plodding along. We have money in other assets. Look, I'm not a big fan of overseas stocks. People want to go, okay, yeah, we're going to be diversified. I'll go along with that. I don't like bonds. I go along with that. But I think for me, we got enough bonds to keep us, from my perspective, is I would vote against adding to the bonds. That's all.
I have a question on page 28, right?
Excuse me, this is Rick jumping in here. I apologize. I have 7 minutes to get to my plane before they close the door.
Okay.
So I can hang on for about another 2 minutes.
Hey,
Apologize.
My question is where does AIS, the UBS AIS fit in that chart there in terms of correlation as well as in terms of risk and return?
We classify it as a hedge fund, so it's a core hedge fund where we expect the return to be between stocks and bonds. You can see the risk level because it is a totally differentiated risk pattern and return pattern is much lower than stocks. You can see the correlation between hedge funds and US equity. These funds tend to be a little bit net long. So UBS, probably not as much. UBS correlation's probably closer to 0.2 versus ABS, which is going to be closer to 0.5 or 0.6.
Probably let Rick go.
Yeah, you want
Yeah,
to,
Rick,
Yeah, we're good. We're good.
Please catch your
Go,
flight.
go get your flight, Rick. Thank you.
thanks, Rick.
Thank you all. We'll talk to you soon. Okay, take care.
One of the things too is like we have, for example, we have absolute return, we have long short. Those are supposedly protections against a down market in the stocks.
And I think the only reason we're bringing this up is because Blackstone was terminated. And in discussions after they were terminated, the consensus of the board was that there was no desire to hire another global equity long short manager to replace Blackstone.
Right.
So those two Blackstone and ABS represent an 8% allocation in the portfolio, 4% each. Now that Blackstone is gone, you still have an 8% target, but you only have one manager representing 4%.
Right, but real assets also is considered kind of, for a while,
Sure.
we always put them into bond portfolios. So if you look at PIMCO, absolute return, and global long short, that's 33, 28, and 21. So that's 50, $83 million more than just fixed income.
Well, the PIMCO all asset is not,
Well, PIMCO All Asset has some stocks, some bonds. They even talk themselves about how they are a three-legged stool.
Yep.
Right? So they've been in here. So what
Yes.
I'm saying is, we have items in here that you could say correlate towards the bond market. And having the long short money is supposed to be, if we're talking about getting into more bonds and selling stocks because of risk, but we have long short, so that's
Yeah.
supposed to be a buffer also. That's one of the things you've talked about.
Agreed. And if the
It
board's
has a high
desire,
Correlation with equity markets and
correct,
bonds do.
and they've gotten killed on the short side in the last
I mean, I'm not a big,
5-10 years.
and if the board's desire
Why don't
were,
we just, we're talking about $4 million.
no, we're talking about 4%, 4%, not $4 million. Yeah.
20 million.
Or 20 million.
20 million.
And
20
plus,
million.
and we're taking
Why
the
don't we
money.
buy 20 million in 2 years?
Do you,
I-
well,
by
the
the
other thing
way,
is you could
I wouldn't
increase your
disagree with
cash
that.
target.
Hmm?
You could also increase your cash target.
well, that was
And
my question.
hold-
So if you have on the agenda cash needs,
Cash outperformed bonds in the
no,
last
no, no,
7
no,
years.
no, cash needs for paying pensions.
Yes.
And we're taking it all out of equity. Right? We're not taking any of
Why,
it.
why?
Well, we're recommending, that's
Well,
what we're
why can't,
recommending.
why can't we use this?
Oh, there's,
In other words, if we're gonna get 20 million, why do we need to put it into something just?
Well, I
No,
put it
no,
into
no,
cash?
we're
I don't
not
think
getting
we
20
would put it
we're
in
not
that.
getting 20 million. What they're recommending is that we would
Yeah,
roughly
that's-
move 20 million
Yeah.
out of, say, stocks.
Yeah, yeah.
But what we're doing is,
Yeah.
we are already
Well-
gonna be downsizing our stock portfolio because
correct.
the recommendation you have.
But the asset allocation, it's not about reducing equity. We're not recommending reducing equity. We're recommending, because of Blackstone's termination, taking that allocation, even though it doesn't exist anymore, is still in the investment policy.
You're saying lowering that amount.
Correct, to what
Correct.
you actually are today.
Okay.
And if you increase incrementally, whether it's fixed income, absolute return, global equity, long, short, which if the desire is, we don't like fixed income, UBS has done a great job. Maybe we incrementally increase the allocation to UBS and incrementally increase the allocation to ABS. We can rerun it, see what it looks like, and most likely support it. I think the idea here is really, we're not going to all of a sudden sell a bunch of stocks, flood it into fixed income because we increased the target allocation. It's first, let's confirm the asset allocation. Then let's take a look and how can we transition towards the target? It doesn't have to happen overnight. I think the board's been underweight to fixed income for as long as I've worked with the city, which is totally fine. And it's done very well for you. And there's no reason you can't continue to be underweight fixed income even with a policy change.
One of the things that you said, I would agree with that, and I thought I did ask about whether we could just go, to me, there's gonna be a level where possibly rates, some rates say in corporates could go to 6.5%. Maybe single A's, okay? And then you could say, okay, since our target is 6.5%, I would be happy to say, all right, so we'll take $50 million or $100 million and put it in a bond that's paying 6.5%, because then we say, now we're making our mark. We know we're gonna make our mark without the risk per se. I mean, the risk would be still, at the end of the day, we still have all that money. The yield coming in, even if the bonds went down in value, the yield coming in would pay the pensions, right, on our assumption. And what you just said about like buying 2-year notes, I would be fine with that. I would be fine with that. 2-year note, even go out on the yield curve to 5 years. Go buy a 5-year note. because the performance of these guys has been terrible, absolutely terrible. I mean, and we pay a fee for people that just make less than 2% on our money. And I would say, if we could go to Northern Trust and say, hey, you know what, for a buffer to make sure we're safe, we'll put 20 million, 30 million, we take 50 million, take some money out of the bond guys, take $50 million and buy 25 million in 2 years and 25 million in 5 years. Now we know we're getting at least 4.25%. I would be fine with that. I mean, I know that, you know, to me, I've always wanted liquidity being important. And if you bought stuff like that, you could always sell it. I mean, if you got squeezed, which I couldn't imagine that would happen to this fund, you could sell them still, but it would be a definite cash flow into the pension plan, and it would be very minimal risk.
Plus, if you hold to maturity.
Hold to
Almost
maturity.
no risk, right?
Right, almost no risk. I mean, you know, and again, we'd be ceding, say, 200 basis points to our mark, but we would still say that we have a reasonable amount of money in an incredibly safe investment, treasuries.
Mhm.
I mean, that would be fine with me.
And I know we've talked about the issues with owning individual bonds and securities. You know, if that was the desire, we would recommend increasing your cash target. Holding 90-day T-bills in a fund that has returned 5.5% over the last year. You know, if you wanted to increase your cash target from 2% to 4%.
To me, that would make the most sense if we're gonna need to draw on that money to pay the pensions anyway.
But keep in mind that most likely, based on the last few years, in order to replenish that cash, we're gonna be doing the same thing that we're recommending tonight,
Well,
which
the
is
money's gotta come from someplace.
correct. And it's
And if
gonna
we
come from the
increase-
equities most
No, if
likely,
we
so we're gonna be in the
increase-
same
No, if
scenario.
we increase the target for equities by 4%, if we increase the target for fixed by 4%, the money's gotta come from someplace. If we increase the target for cash, the money's still gotta come from someplace.
Right.
I don't see any benefit to increasing the target for fixed. I'm not sure I see the benefit to increasing the target for equities if we gotta come up with the cash.
Well, I meant not
Put it
only,
in, put it in and take it out.
I didn't mean just reallocating, I mean replenishing, because that cash is not static. We're gonna be pulling from that every few months to pay the benefits. So then we have to reload, and that is most likely gonna keep, assuming that equities, let's just play the hypothetical game, keep outperforming, then we're gonna be taking off of that, just like we're doing now, frankly. It's gonna be the same sort of exercise. We're just kind of, you know, shifting things around for, you know, viewing pleasure. But
Jim, what do you think?
I'm fine with, you know, I'm a believer in asset allocation. I'm a believer in looking long-term or history. And I kind of almost completely discount the last 2 years.
Yeah.
Just odd, you know.
In which regard? I mean,
In terms of, you know, in terms of what happened to bonds, you know, and the fact that they suffered so badly when equities were down and so on, but, you know. So I'm okay with keeping fixed income where it is. I'm okay with looking at some of the alternatives, like the all asset fund, you know. I'm okay with either one of those.
what do you think about if we put, first of all, we're gonna take later on $9 million and then 4 more million, right? So we're taking 13 million out of, I don't know if you saw this is Chitsame unfortunately isn't here because she's on leave for bereavement this week. And I do hope that she's well and her family as well. So she's requested basically $13 million for 3 months. Now, after June, there'll be money that comes in from the city, right? Because we go to June 30th.
Yeah, it's usually
So we'd get
early
an
July.
infusion of cash into the pension plan, usually in July, which might mean that we wouldn't need to draw as much money, you know, after June. But we could look at, if the money, you know, I mean, would we be able to, if we increase the cash position, by definition, does the cash, I mean, like, I mean, for example, you know, probably everybody knows this, but bills go up to 1 year, notes go up to 10 years, right? So when we define cash, can cash be a 2-year? Did you see, you know, you see
So
what I'm
you're
saying?
saying the cash, the part the cash pays
It's a money market fund.
money market.
Yeah.
5.5%, 4.5%.
Yeah.
Yeah, because, yeah, or
Yeah,
even,
it's
yeah,
it's mainly 90-day,
Yeah,
Yeah, it's for short-term
Yep.
stuff.
and it's liquid.
Yep.
I think from an institutional perspective, it's a perfectly reasonable allocation for liquidity purposes. It has had a great return. There's no denying that. Is it a place that we expect return to come from? No.
Yeah.
I think it's great that it's returned 5.5% in the next 10 years. If it returns 0.01 like it did for the first half of my professional career, would I be surprised? No. But, you know, in terms of liquidity and having a safe asset there to pay benefits when you want to pay benefits, you know, we have clients that have much more complex fixed income portfolios that include treasury funds that are there to pay benefits. Cash is a part of that. And, you know, if you wanted us to bring back an alternative that increases cash and maybe increases real assets or absolute return on by a percentage, which the reality is you won't make any changes. There will be no cells to transition to the target. We're happy to look at that and bring it back to the board. You know, understood on fixed
Do we
income.
have a proposal for where the 13 million comes from?
We
Yes.
do.
yes, we do.
We do. But we'd like, I think we've heard a lot. I think from our standpoint is, you know, we're talking about moving this allocation and the target that really is, it's in the investment policy, but it's not going to change the way the fund is invested.
Yeah.
But getting consensus from the board on, okay, not fixed income. You know, I think from our standpoint, we think you have enough public equity risk in the portfolio. So if it's not within US equity, international equity, and fixed income, increasing cash from 2 to 4%, is that reasonable?
I think right now the band isn't it 0 to 5?
0 to
cash,
4, 0 to 4.
0 to 4, so, you know, we could go 0 to 6. I mean, we can change these.
Yeah.
You know, I mean, only, and I'm not saying, and again, we could go to 6% cash, and that doesn't mean that we can't go down to virtually
Correct.
0 in the future. And I want to say that, you know, I do have concerns about the stock market here because, and a good example is my daughter, she did a paper on artificial intelligence at Alliance Bernstein, and she recommended buying
NVIDIA?
NVIDIA and AMD. So she has a little account of her own, and she bought AMD. And she bought it under 100, just under 100, and now it's like 204. And I'm trying to tell her, it isn't this easy. It's just, you know, you just don't make 100% less than a year. And I do look at the market, and I do look at things like what the price earnings ratio is right now and things like that.
Keep it?
You know, so I do
Alright.
have some concerns. So I'm not saying that we should put this money necessarily into equities. You know, I'd be happy to put it in cash and buy it, you know, money market account or a 90-day bill. That's fine.
We're talking rebalancing, it's gotta come up to 100%. So
Right.
if we raise cash from 4% to 6%, something else has to go up 2%.
We're down 2%.
Well, one of the things is,
Well,
Oh,
The
no,
target-
we have to raise,
The target's
if
2%.
we're lowering
right,
Gold
hedge funds by 4%, then we have to raise everything else by 4%.
Correct.
And if you talk about raising cash by 2%, something else has to go up 2%.
Right, but, or even we could raise the cash by, by
Well,
4%.
That's the
because-
alternative.
Right,
Yeah,
that's the
yeah.
alternative. I mean, one of the things is we're
Yeah.
already gonna be we're reducing our stocks now. I mean, I think you just looked at this, we're gonna reduce it by, I mean, in fact, we could
Yeah.
even, I wouldn't say, your proposal for taking the 9 million, talking about 2 million out of real assets. If you wanna take all the money out of, stocks, that's fine with me. Do you know what I mean?
That might take us out of the target.
Well, we just did
No,
it,
the targets,
we did it
one of the things we did
more-
is we did very broad
Yeah, I
targets.
know.
we did it more from the perspective of like rebalancing. Like the whole rationale is it's discipline, unemotional, right?
Yeah.
Like balance past the target. So for real assets, we're suggesting pulling 2 billion there to bring it closer to back to target because it's overweight. And that's really like the very, very simplistic, and you guys all know this, as to why we're also suggesting pulling back from, the equity because that's overweight. We're not touching conversely fixed income because that's underweight. So it's just a rebalancing exercise to stay disciplined.
Trim your winners.
Right, right.
You know what, I'll disagree with the term overweight because we have a band. And they're within the band, and if they're within the band, they're not overweight.
Overweight the target, which is as per the IPS. So we do have a target.
The
We have
target-
bands around the,
Excuse me, the target allocation is 60 to 75.
that's the target asset
That's the
allocation
target,
range.
that's the range. And we've always said we're gonna stay within that range. So that's what we've done.
I'm not,
This-
I'm not
this-
disagreeing with you. When I was making my comments, I was talking about the target asset
Right, but
allocation.
we've never, I don't think we've ever actually, as a board, said this is exactly our target. We've never done that. We've always said we're gonna stay within this
Use that
band.
But
much
it's-
smaller range.
It's
Right.
defined in the IPS though, so it was a vote at some certain point in time that was the target.
I would have to look at that, but I do know that even when we went over this before you were here, we talked about a range so that we could be flexible within that range. Because
Absolutely.
if we say we're at 65% in stocks and the next meeting it's 66%, we don't go, okay, we're gonna sell stocks.
We agree
And
with
the
you.
range,
And
the
that is-
target is the middle of the range. That's
That's
really.
all, yeah.
what
That's all it is. We completely agree. Every client we work with is the same thing. You have these range that you can create flexibility around, so you're not forced to sell back if you don't necessarily have the need to or desire to. But the target is always the target. It's a singular number.
Let me ask, getting off on a different question. In terms of risk and return, where does Callan position ABS and UBS relative to equities and fixed income? Somewhere in the middle? Is one more one direction than the other?
So I'd say ABS is a long short fund, so they are gonna be net long 50 to 60%
So they're
typically.
tilted toward equities. yeah.
Correct. And UBS is really lower. I would say their beta is probably 0.2. So combined, we would expect their beta to the S&P at less than 0.5. But, most of that equity risk is going to be within ABS, and UBS is much more uncorrelated sources of return.
Mhm. And how has UBS done when equities have gone south?
They've done very well.
And is that an alternative for fixed income?
Yeah.
Like, that's what I mean. Some of this,
It is.
we're not as, it's somewhat deceptive as far as what we have, because some of these other places that we have funds, I think.
Yeah. Get us halfway there.
They get us halfway there, right? I mean, again, like PIMCO is, I think they said they were about a third stocks, a third, commodity-based things, and a third bonds, roughly,
Yeah, that's right.
so.
So
And
UBS.
so basically, there's gonna be 20 million, roughly.
So this is sorry, Frank, just to answer Jim's question on how UBS does in down markets. This is relative to the universe. When hedge funds are down, UBS participates 25% of the time, which is positive.
Yeah.
And when hedge funds are up, they participate 96% of the time. So we could run that versus US equity too, to see what it is.
Is that page 108? Is it?
109. Sorry.
Yeah.
Yeah, no, I mean, so basically, there's gonna be money coming out of BlackRock, right? But
No, we're just.
what is your,
changing-
what
just-
is
just
this
changing the-
proposal
just
to move?
Changing the target
Right.
number, that's all. I'm not taking money from anybody
Right,
at
but,
this point.
but,
That's right.
so when you talk about adding, if the idea of adding to bonds, what you're saying is you'd want us to sell stocks
Not necessarily.
or some other
If
asset
we,
in
okay, if we increase the
Yeah, I
target
think,
for bonds,
you
you
know, you-
have to raise the money somewhere.
But
to buy
but
more
it would
bonds.
also not be a
Yeah.
one-time event. We wouldn't say sell $20 million worth of equities tomorrow and move it all into fixed income. We could take many different approaches. We could make the range for fixed income so that you don't have to put any more into fixed income. And you can have the board's desires to be underweight to fixed income, that can remain. And then when the city's contribution comes in, maybe a little bit of that goes towards the underweight asset classes. And then in the fall, maybe a little bit more goes into the underweight asset classes. So there's approaches where you don't have to make wholesale changes. You can dollar cost in, whether that's over a year, 2 years. I mean, we have many clients that do it in different ways.
Do you feel that we have too much risk in stock because of our stock holdings?
For your discount rate, we think that you don't need to take any more risk.
No, I'm not saying about adding money to stocks. I'm asking if you think that we should reduce our exposure. I mean, we do reduce our risk exposure here.
I think because you don't have a real allocation of private equity any longer, that your allocation of public equities is reasonable.
Yeah, because we don't, right. Basically, it's a substitute for private equity.
And this fund's gonna be around for decades.
Yeah.
40, 50 years, I don't know how long, but
And it's 80% funded.
yeah,
So, the city's making their contribution, which is great, but
you just have to
you
cover
still
benefit
need to
payments, that's it.
earn,
Right. I mean,
Well,
well,
close that
that.
gap over 20, 30 years.
And if that discount rate keeps dropping potentially,
I
then
don't think
there's,
it's
I'm not, you never want to bank on that, right? Obviously, but that has been directionally.
No, we already agreed at 6.5, because that would be our target. We're not,
Yeah.
it's
It's not gonna go.
It's not going any lower.
So when you
okay.
look at
And
the,
besides, actually, we don't make that decision, the city makes that
Right,
decision.
right,
And the city is very firm to say that we're happy to get them to 6.5.
Yeah.
Okay.
And that was only because of Henry
Pulling
being,
teeth, yeah.
and also when we went down, by the way, when, before Henry, who's it? He's
Sheriff
now
Bob Barron.
on the school
Bob
board.
Barron.
Tom,
Tom
right.
Hamilton.
Tom Hamilton, when we would move the discount rate down, what he did is he changed the assumption of when we would be fully funded. So because every time you move the discount rate
Yeah.
down, you have to add to your annual amount.
Right.
And so he didn't want to do that, so he just kept saying, oh, you're
Push the problem.
pushing it out.
Oh.
Henry didn't do that, because I talked to him about that. He said, no, we're still
well, it's closed,
marching
it's
down.
because it's closed now.
Yeah.
Do
So
you
he
know
can't,
what
he doesn't
the-
have that option.
Do you know what the
There's
range
no new
is for
participants are
cash?
going in.
Right, there's
Excuse
no
me?
new participant, no, but what I meant was that when you change the assumption, you have to put more money in
Right.
to fund it,
Yes.
Right.
you know.
But what I was saying is Henry can extend.
Oh, yeah, no, I know.
All of our classes have a range. Do you know what the range is for cash?
Yeah, it's 0 to 4 right
0
now
to
with the
4.
2% target.
Yeah.
Okay,
So if you bumped it to 4,
so
in
we'd have to
theory,
change the range for
Mhm.
cash.
yeah, but that's right. That's
So we
a,
could do that in a vote.
that's
Okay.
updating a
Oh,
Word doc.
okay.
Yeah, that's easy.
I would move that we reduce the allocation for, the target allocation for global equity from 8% to 4%. That we make no change in the allocations to either equity or fixed. We raise the range from cash to, what do we say?
Well, you gotta raise the target.
No, we gotta raise the range first, because if the range is
0
from-
to 4.
from 0 to
Or
16, then the target is 8. And the only way you get to
That's-
the target of 8 is to raise the range from 0 to 16.
Okay, that's fine.
Well,
Usually-
basically what you said, the target is the middle number.
Yeah, well, usually in the investment policy statement, you set your targets and then you build the ranges around them. So you would increase, we're talking the same thing, so
Yeah,
it's,
yeah,
just,
that's
yeah,
right.
that's fine.
Okay.
Well, I think we,
Does that
I think
cover,
what-
does
what
that
we-
cover everything?
pretty much, but I think what we did was we just I don't think that we ever really looked at it as to say, we're having a band and we want to be in the middle of that band, because we went over this, you weren't here at that time, but it was a matter of, we don't want to have, we want to keep our flexibility. So we made broad bands, but we never, in fact, we talked about it once. One of the things is to print this out, to have a different, to put the target in would mean that you got another 2 lines, and that would be just more work, right?
Yeah, and I think the reason that we're bringing this back is because the investment policy states the target asset allocation.
Mhm.
It also states the ranges.
Right,
But if we have an asset class like global equity long short that has an unrealistic target asset allocation, we should update the IPS and reallocate how more in line with how the plan is being managed.
but if we were at 60% in stocks or 70% in stocks, we don't always sit here and say, okay, well, we have to make an
No,
adjustment.
no, definitely
Right,
not.
we've always tried to be flexible,
Absolutely.
right?
Charlie, can I just come back to it was a motion, I think. So I just want to repeat back, make sure I'm hearing correctly. Using the hard numbers, the target asset allocation numbers, the 8% in global equity, reduce it to 4, move that 4 to cash, which would take the target there from 2 to 6, and then you can build whatever range you want around that. That was the motion?
Yes.
So what you
Okay.
do is you would basically go global from 8 to 4, so we'd sell global.
We've already sold.
We've already
Right, sold the global.
Yeah.
So that's just based on what the fact is now.
Yeah, and so then what we're doing is basically, I mean, we could raise the target to
We're gonna raise-
10% in,
We have to raise something by 4%.
We have to raise it to 6 if we want to
Yeah,
put it all
well,
to cash.
if we want, I'm proposing, rather than raise bonds, rather than raise equity, we raise cash. We raise the target for cash.
so basically, the money from global will all go into cash.
There's no money to.
There's no
it's
money.
just-
I mean,
It's
no
just
money.
the target.
aspiration that we're
proposing. The aspirational target, that's a good
What's being proposed here is a change to the IPS, right?
Correct.
Right.
That's right.
So next
Yeah.
month,
The
we
diff-
would
yeah,
make
the
the edits
reason
and
is
bring them
if-
back
If
to-
we raised the allocation to fixed by 2%, then we'd have to fund that. Then we would have to get.
Not
some-
necessarily. We don't have to fund the
Well,
cash either.
as long
if
as
you
we're in the
don't-
range, we're
if you don't
fine.
want.
No, even Charlie, what we were just talking about, we wanted to have broad,
But that's what you keep saying, yeah, we'll do this over time, we'll buy something
No, no.
here, we'll buy something there.
no, no, what I
You
mean is,
know,
but
That's
just.
what I don't wanna do.
I don't disagree with that, but what I'm saying is, when we reviewed all this, we put, I mean, if you look at you know, this is a range of 60 to 75 in stocks. So that gives us a lot
Yeah.
of flexibility, and what we did was, and as I said, I never looked at it and said, okay, well, that means that the target allocation is always the midpoint, because, you know, we could be flexible with that. And all we wanted to do is not be in a situation where if the stock market exploded and we're up to 72%, we were saying, oh, then we have to sell
Yeah.
the stock. You know, and by the same token, if we don't feel that something is a place to be in, we want to still be in the band, but we could be at the lower end of the band. And I mean, you know, so, you know, I'm not, that takes risk off the table, right? If we put more money into cash.
If you, I mean, yes, the targets themselves are just numbers on a paper. Unless you actually shift the allocation, shift the dollars, then the risk profile changes. Otherwise, it stays exactly the same and we're just talking hypothetical.
Yeah, yeah.
So
Because
Charlie, you're
every time we have a meeting, one of the points that you always make is, this is very close to the target, this is overweighted by 4%. This is
Correct.
But
overweighted.
Charlie, you're,
And right on paper, from 8% to 4% is clearly overweighted.
Mhm.
I just want to eliminate that, as you've been recommending, but only by increasing the target for cash, rather than increasing any other target.
so the cash target goes from 0 to 8,
2 to 6.
2 to 6.
2 to 6.
Yeah, the target goes from 2 to 6.
I wouldn't do that, because the reason why is because if rates go way down, we might not want to have much money in cash.
We don't have to put it there, but that's the target.
Yeah, the range is still 0 to,
Yeah, it would be zero, so what I'm saying is the
0,
lower
7,
band,
8, could be 0,
to
10.
keep the lower band at 0.
Yeah.
To move the upper band up,
Yeah, yeah.
not both of them.
Well, that's what I had said originally. from
That's fine,
0
we
from
keep the
0 to
lower-
12, if the middle number of 6 is the target, 0 to 12 is the range.
You've been quiet, what do you think?
I think it's a.
You think you're regretting going on the
No.
board? Here, have a bag of chips.
What's the reality you really think is real? And I see both sides.
So cash would again go to what, 0 to 8?
Well, right, it goes, the important number is, it goes from 2
to
to
6.
6. We have to move the 4% as
Right.
allocation. That's the key. You can do
So the
whatever
target- the
you can
target
do
goes to
wherever you
6,
want
yeah.
to land on the range, but you have to move that 4% coming out of global equity somewhere.
Yeah, what you're saying is all of the targets have to total 100%.
Correct.
That's right, yeah, so.
Because
making
the
making
ranges
cash
don't, the
target
ranges
from
don't
2 to
target
6,
100,
that's
they
right.
don't total
That's right,
100%.
that's right, that's right.
Rich, what do you think of doing that, taking the money and putting it in
Well,
cash for short-term
I
rates?
think changing the range on cash is fine.
How liquid is UBS?
it is quarterly liquidity with 30 days notice. So if you submitted a redemption or partial redemption or investment before April 30th, which is approximately,
Well, March 30th,
no,
right? If you submitted 30 days right now, if you put in a redemption, you wouldn't get it back until Q3.
2 or 3 months notice.
it's
Lead time basis.
roughly 4 to 5 months. So
Yeah.
if you submitted it in the next month, that would be because it's 45 days before
Before quarter end, so you wouldn't get it back till Q3.
you'd get it back in July.
Yeah, and I just don't think
Right.
you're ever gonna want 6% in cash, that's $30 million,
Well,
that's a whole year's worth of benefits.
No.
I mean, we're
No.
not hitting
no,
the target, I
what-
get that, but
right, well, we're talking about the cash being basically
5%.
almost short-term fixed income.
And the reality is
Right, I mean, if
UBS,
we can buy,
Yeah.
Rich recommended, say, the 2-year, pays what, 4 a quarter now or something like that?
another option is UBS right now is 5.8% to a 4% target. If you increased that to 6%, you would not invest any new funds into it. It would be right on your target. And you could increase cash from 2 to 4%. Where, from a risk perspective,
Yeah, it works.
you're
Yeah.
taking the risk off the table, you're increasing your liquidity with cash. And UBS has been a great manager for you for a long time.
And the question was, with those two options there, what's the risk return of those two options?
Well,
Right.
not anything,
Nothing, it wouldn't.
because we don't move it, we're not
Because I'm
running
really
money.
Because I'm really like, So that would be the same thing it is today.
But over time, you'd expect UBS to do better than cash.
Correct.
Yeah.
Yes.
Right.
So I'd say, I'm fine, take down the 4 on the global, but I'd go 2 and 2.
Yep,
I look at myself.
2 for,
that
2 for
reflects
UBS and 2 for cash.
closer to what we're doing. With the state that we're in right now.
Well, I can amend the motion to change it to that. Sure. Instead of change the allocation, the target to cash 2% to 4%, and the target for absolute return from 4% to 6%.
In that case, there, in page 20, does that show us what our current risk return is? Is that the 7.3 and 12.1?
Page 20.
So page 20 is using our capital market assumptions. You can
Yeah.
see the current,
Yeah, you see it.
Oh, it's 6.5
which
and
is
7.3?
spelled incorrectly. Yep, so 7.4% annualized return with risk of 12.6%. And that's essentially,
Which,
it would be reduced, the return would probably be reduced a little bit
Yeah,
and the
which actually
risk
is
would be
slightly
reduced a
higher.
little bit.
A little bit.
than the policy.
Because you're increasing cash.
Yeah.
You're basically doubling cash.
Pretty close.
I mean, this,
You're slightly reducing your hedge fund exposure from 12 to 10 in total. So it's,
Yeah,
it would be on the margin.
right. And versus the policy, it's, that's actually the current is slightly higher, like by, 1 basis point. Or 10 basis points, excuse me.
Which is semantics when we're talking
Right.
about 10-year projections.
Right. Sharp ratio is roughly the same. Drawdown's the same. So we're not really changing anything.
Yeah. But what's interesting is that, on page 16, when you show that theoretical, 7% return, the risk of 8.6%.
Correct. You
Right.
slash your risk in half. But
And
this is not for,
This is not real.
Is
This
that
is not
real?
for
That's
normal.
that's
These are
theoretical.
so these are our assumptions
correct.
from 1994. What were our 10-year forward-looking assumptions? And
Okay.
back then, rates were higher.
Yeah,
And if you had a 7% discount rate, you could put 90% in bonds and call it a day.
yeah.
It was And then you look at 2022, where this was before the interest rates rose, where bonds were earning nothing. And you had to put 96% of your assets in risk assets in order to get 7%, based on
Yeah.
our assumptions.
Yeah.
And the chart on the right is taking into account the 5.5% rate hikes that we've seen over the last 2 years. Using our forward-looking projections, you can see how significantly fixed income could play a role if our projections are in line with expectations.
But this doesn't take into account any sort of like illiquidity benefit payment component, right? This is just saying if you were to build a portfolio today
Yeah,
and to get to 7%, what level of risk would you have to take on? And so that's saying, hey, in the last 2 years, you could actually cut your risk in half and get the same return.
Yeah.
With an increase in fixed income, creating a portfolio today. Everything else irrespective.
we're also saying here, we're looking at this, we're saying that we're actually forecasting 0.9% more return than we need, but we're taking on more risk, obviously. So think of the 7.4% versus 6.5%.
Right.
Yep.
Which,
That's what we're doing
which I think, when if the plan was 110% funded, like a lot of corporate pension plans are,
Yeah,
they're 100% long duration fixed income where their liability, whatever that duration is, those are the bonds they buy and they fully hedge out all the risk and they don't care what they return because liability flows as the bonds flow. And it's a different discussion. But here with 80% funded, the city's contribution, given the withdrawals going out every month, is not going to make up that 20%. So the plan needs to earn more than 6.5% to fully meet its obligations over the long term.
I say that again, I'm not sure I followed that last one, but I'm thinking, because if we go back to the very first page, we have to make 15 or 20 million more per year than the city's putting in.
Correct.
from now till eternity,
Yeah,
right? So how does that tie back to that, what you're just saying? Is that the 6.5%? That's actually, that's much less than 6.5% though.
we've got to get more than 6.5%.
I don't know. Say it again, why is that?
Because the plan's underfunded.
We're underfunded.
So even though it's great the city's making its contribution each year, if
We're digging out a hole, basically.
Yeah,
you have
whereas,
to earn, you can't just, the city's contribution is gonna increase and increase. And if the plan doesn't reach 6.5% or only reaches
Yeah.
6.5%,
There's a problem.
there is a problem.
you to make up that difference, that 20% away from 100, where, right, in theory, I mean, to really, you gotta get to like 120%.
The thing though is that the city does have a plan that I think it's 17 years left where they would go to 100% funding. And so if we underperform, the amount of money that the city contributes
Yeah.
for the fiscal year increases.
Okay.
So all we're doing is if we make 6.5%, that means that because we're like, as Rich said, we were only 80% funded, the city's contribution will be higher.
Okay.
Because the outflows will be greater than what our income was.
Okay, all right.
Is that a lump payment, or how does that?
That's a
part
lump
work?
payment.
Lump payment?
Goes
Okay,
in like in July, I think.
got it.
Okay, I think I'm following, right? Thanks.
You know, and like the OPEB was more than for a while, it was more than 100% funded, so they weren't putting any money in at all.
And now it's negative cash flow.
Yeah, now it's negative
Well, that
cash
happened
flow.
with this fund years ago too. There was a period of years where the city made no contribution.
Well, that's why we were,
Right,
I mean, one of
And
the
that's the
things
problem.
is
that's.
we were overweight in stocks in the OPEB because one of the things was we started the OPEB in like 10 maybe or somewhere 08, 10, somewhere around there. And it was like, okay, they told us then we wouldn't be taking money out until at least 2020. Because of that, we said, okay, this is, as a long-term perspective, stocks would be a better investment. So we're overweight in stocks.
Mhm.
Than what we are in the regular fund.
Okay, all right. That's all, thank you.
But now it's negative because like we're taking money out, but that's what they had told us they would be doing. And it helps the city's budget because before the city was not only putting money into OPEB, but it was still paying for benefits directly. Now what they're doing is just saying, we're not only putting, what we're doing is we're taking money out of the OPEB as we plan to pay part of the benefits.
Just keep in mind that 6.5% is crucial, because if we don't make that,
Yeah, no.
then the city has to raise taxes to raise the. to raise
I
the
buy
city
that, I buy that. I was
contribution.
wondering,
That's the scary part.
6.5%, is that our target, because that's gonna help, that's gonna basically balance the equation, or do we need more than that? Or, and in a way, I almost wonder why we need more than that, why
Well-
are discount rates not raised to what we need?
But the other thing is that,
Let me answer that one. Quick.
Yeah.
It's 6.5% because when it was higher,
Yeah.
it was unrealistic.
Yeah.
And we had to take riskier investments
Too
to try
risky.
to meet it.
Yeah.
Yeah, and that's basically the target that we're obligated to try to meet.
And the city knows that target, right?
Yeah,
They commit,
right,
we-
yeah.
and then, so they commit to that,
right,
actually,
it's not our fault. In effect, it's not our fault that the fund is underfunded.
underfunded.
That's the city.
Yeah.
What we're doing is we're saying,
This
we
is what we can
lowered
commit
the
to.
number down, the number came down. One of the reasons why was when it was 8.5%, the long one was paying 7 3/4, 8%. In fact,
Easier to do that.
we were underfunded more than we are now at that time, because if you're 100% funded, you could have said, okay, we're just buying bonds, and like Britt said, some of these funds could do and say, okay,
Done.
we're just gonna come over here to eat chips and BS, because we're not doing anything.
Yeah,
And
But
there are gonna be years, they're gonna be,
Yeah.
Dave, they're gonna be fiscal years where you're not gonna hit 6.
Yeah, no, I understand, yeah.
And the actuary smooth, there's 5-year smoothing.
Yeah.
So they're gonna be years like last year where you did great.
Yeah.
And you returned over 10%.
2 years ago.
2 years ago where you were down 10%. And over the long term, the goal is to outperform.
Okay, all right. That's helpful, thank you.
And the other thing too is, by the way, is because we have a negative cash flow,
Mhm.
we don't want, we are less, we're not as risk-taking as some funds are. So we can look at liquidity. is important because we're negative.
Mhm.
And also, our risk tolerance, we don't have, I mean, we were in some stuff before, like infrastructure that was a disaster, and a
Was it
few
liquid?
other things, right? And so we're going like and even, well, when we had the gentleman in for private equity, it's like, there's some money there since '02.
Yeah, yeah.
Small,
that's right, yeah.
but when somebody says we're gonna get the money back in 5 to 7 years, the majority of the money we have there now is a fund from 14. Well, that's 10 years ago,
Yeah, yeah.
so that's been kind of our strategy here, is to stay liquid.
Mhm.
I think, like I think that even, I mean, not only are we in an index fund, we can get the money easily, but also, we don't have that much money that we can't get right away, right? I mean,
It's just the hedge funds
just that, yeah,
and the private equity,
right.
what's left.
So, that's a big plus, I think, for us,
Yeah, yeah.
So this agenda item was labeled rebalancing, but do we also adjust the investment policy?
That's for
So
doing.
we'll bring the investment policy back at the next meeting
Okay.
for the formal vote,
Formalize
and
it,
we'll,
yeah.
we'll update to take 4% from global equity long short, add 2% to cash, add 2% to absolute return, and update the ranges accordingly.
Well,
But we do,
there's just a motion on the table, hasn't been seconded, we haven't voted on it yet, so don't do that until we vote.
Fair,
Right.
fair.
So should we restate the motion
And vote?
and go?
Well, yeah, why don't you propose again what you would like to do?
Okay, what we're talking about are the targets, and I don't want to change any of the targets other than cash, raising the target for cash from 2% to 4%, and raising the range to
From 0
0
to
to 6, and changing the target for absolute return from 4% to 6%.
Yeah.
Do you know what the range is?
0 to 6.
36,
And reducing
0 to 6.
0 to 6, okay.
or
So
two,
we
range,
should,
whatever.
we need to change the range for absolute return from 0 to 8, and then reducing global equity long short from 8% to 4%. Thank you.
and do you want to move that range as well?
Probably not necessary.
Okay, right now it's 4 to 12.
Yeah, that's all right.
But do you want to have a
We're at the
range
bottom.
below it?
We should probably do
3 to 10.
You know what I
0
mean?
to 8.
Yeah.
0 to 10.
0 to
0 to
8.
8,
yeah,
okay,
okay.
change that range to 0 to 8. Okay.
Okay.
Give yourself the room.
I'll second the motion.
Yeah, I just want to read the motion again, okay? The proposal is to adjust the cash range, ranged from 0 to 6%, absolute return to 0 to 8%. Long, short change to 0 to 8%, have 2% of the 2% of the money from to go into cash, 2% to go into absolute return.
We didn't do anything with long short, did we?
We did.
We're not
We had to
moving.
reduce it because of Blackstone.
Oh,
Yeah,
okay.
because
So
that's,
reduce
I
the-
mean, the Blackstone.
Oh,
money.
yeah,
That's what I mean.
got it.
Like the money's
Okay.
already
Yeah, that's gone.
gone. So we're not changing, we're not moving any cash. All we're doing is changing targets.
Just changing
and
targets and ranges.
That's all.
We spent that money already.
Belize.
And Brazil was wonderful.
So I'll second that.
All in favor?
Aye.
Opposed? Passes unanimous. Excellent.
Great.
Okay, after that beating,
That was easy.
Want to do the rebalance now while it's
you
fresh?
know.
That was a
Is
good
there-
discussion,
is-
though.
is there-
That was really good for me to do that
What's
discussion.
it?
You want to do that
That
while
really
it's
helpful.
fresh? We'll just roll right into the rebalance for
Well,
Richardson.
now, now we need, there's one other thing we're gonna do, we need money, right? We
Chits
did-
May requested
Yeah.
9 million from the pension.
Right,
Right.
and so right now, the proposal is to have 5 million come out of, US equity, 2 million come out of international equity, 2 million coming out of, real assets at PIMCO. I mean, PIMCO is, that's one of the things that has been a little, I mean, if we're talking about reducing risk, do you want to take, instead of the money out of PIMCO, take the money out of, say, make it 6 and 3 out of equity?
We,
Does that reduce our risk a little bit? We're taking another
Does
couple,
reduce a little bit, yeah.
you know? Is that,
That's fine.
is that fine? Is that okay?
Yep.
What are we talking?
We're talking about, first we
9
need
million.
9 million through June.
Right, so
The
we're talking
proposal right now is,
7 million out of equity, 2 million out of real assets.
Right.
Want to make it,
well, maybe take all 9 out of equities, and we're concerned about the equity market a little bit. That would make us come down a little bit and leave the money in PIMCO. Say 6 and 3,
I'm fine with that.
or if you guys want to take it out of real assets, it's fine
I'm fine
too.
with that. 6 and 3 is
6
fine.
and
with
3
me.
is
6
fine
and
with
3
me
is
too.
fine.
Yeah, fine with me.
All right, there's a
Okay.
motion.
Well, when say take it out of US equity,
The
take all out of
BlackRock.
Russell.
I think we're gonna take it,
the
you're gonna
index.
take it all out of the index
Yeah.
fund, right?
Yeah, okay, all right.
Okay, so there's a motion that Charlie just made to take 6 million out of.
Okay, we take,
Okay.
okay, to meet the cash needs, I move we take 6 million out of the BR Russell 1000 index fund and 3 million out of PIMCO all assets.
No,
No.
Silchester.
Yeah, how do
Oh,
we do
I
that?
thought we said take it out of real assets.
No, you're
No.
saying leave it in real assets and take.
Leave it.
Yeah,
it.
equity.
take it out of.
Sorry, okay,
Yeah.
then we'll take
You
it
wanna take
out
it out of
of
Silchester,
developed
or
market Silchester, okay.
or do you wanna do some out of BlackRock and some out of Silchester? We don't wanna take anything out of Walter Scott, because they haven't been here long.
Yeah, the reason we chose Silchester is because you can see Walter Scott and Silchester. Walter Scott's the growth manager, Silchester's the value manager. Silchester's done great, but there's a value bias within the
He
international.
likes Silchester, and I wanna be on his good side, so I'm trying to make amends.
All that I'm just glad there's almost as much in Silchester as there is in, domestic fixed income.
Okay, so we're, so.
6 million out of the index fund and 3 million out of Silchester.
Silchester, and that's a motion, is there a second? Thank you very
Second it.
much. All in favor? Aye.
Aye.
Opposed? Oh, look, he just raised his hand. And I said opposed, I tried to trick you. Anyways,
There you go.
okay, passes unanimous, okay?
And then, the OPEB.
Yeah, we can't do that till we open the open meeting,
Oh, sorry, you're right.
okay? Any other discussion? If not, is there a motion for adjournment? Second, all in favor?
Aye.
Opposed? I'd be surprised if there was. Passes unanimous, okay, excellent. OPEB. Call the meeting to order of March 13, 2024 for OPEB, other post-employment benefits. Approval of the minutes, last meeting, which was very simple.
Motion
Motion
approved.
approved.
So move second, all in favor, aye.
Aye.
Public comment, I'd be shocked. Nope, thank you very much. Performance review.
Great. I will be quick. I have the fourth quarter OPEB performance report. I'm on page 20 of the PDF showing the asset allocation versus the target. All of the asset classes are within their target ranges. There's an overweight to domestic equity, given the strong equity markets. And slight underweights to fixed income and international equity. Total assets on page 21 were 133.8 million. And you can see about 3 million was paid out during the quarter. And Chitsmay, we'll get to in a second, requested $4 million in cash to pay benefits through the rest of the year for OPEB. And then on page 23, performance. Largely, the managers have done very well. The index funds have tracked their benchmarks. And you can see returning 9.9% for the quarter, 16.9% for the trailing year. And your active managers in fixed income and PIMCO have done a good job. So fiscal year to date, on page 24, you can see total return up about 6.4%. Any questions on OPEB performance?
Anybody want to change anything there? Is it 4 million out of one fund? We're gonna leave all the money in international and what bonds.
She needs 4 million for
She
what?
needs 4 million
For the rest
through
of the
June
year.
30th.
Not to June 30th.
Yes, that's for the fiscal
Charlie,
year.
if you want to look at that too, that for
It's easier,
the,
yeah, it's easier.
The whole thing comes out of the
You take advantage.
Yeah, Vanguard funds, yeah.
Okay,
All right, so I'll
is your
move,
motion,
I'll move, we take the 4 million to meet the cash needs out of the.
Is there a
Vanguard
second?
fund.
all right. Yeah, we want you on the books, okay? Any discussion? All in favor?
Aye.
Opposed? No? Excellent. Is there a motion for adjournment?
So moved.
Second, all in favor? Aye. Even with that long discussion, I was only 4 minutes over, tell your
You
brother.
can tell my brother that. I mean,